let me ask you this. Do you know what the Fibonacci tool is used for? Okay, for continuations, exactly. It's so we can get in with the trend of the market and minimize our risk and maximize our reward. So if you're using the FXPM software, we always draw from the most current extreme to the other extreme. So for this example, since we're in an upward trend, the most current extreme would be the high, the old extreme would be the low. The chart looks a little weird because we did have interest rates come out yesterday, and we had some whipsaws in here. So I'm going to start from the very basic Fibonacci retracement. I start up at the high that we had made, and I draw down to a low. Okay? You follow so far, Kamal? Always drawn. The basic Fibonacci retracement is from a high to a low or a low to a high. Now if you guys go into your dashboard, I've actually put up some new videos on Fibonacci. There's two different lessons. There's a basic or an introduction to Fibonacci, and also an advanced Fibonacci, which talks about confluent zones, placing stops and placing limits. So if you guys haven't seen that, and especially you, Kamal, go in there and watch both of those lessons. If you go in there, it's under the FX Price Action Multiplier Guide, and it's in Module 2. I've actually put together, I think, 5 or 6 new videos that are placed in there, and I'm currently working on some money management ones. But anyways, you draw from in this example, we drew from the high to the low. Now you notice the first level that you should have on your chart, the first level that the price will test, should always be the 23.6. Now if I would have drawn from the low up to the high, so exact opposite, you're going to notice these levels are exactly the same, but now if you look at these levels, look, now it shows that the 76.4% retracement is going to be the first price tested if the market does come down. So the actual level is correct, but the percentage itself is backwards. So it's like you unless you're completely shoving a whole pie in your face, of course, you have to eat a half a pie before you eat a full pie. You have to eat a quarter of the pie before you eat a half a pie. So that's how your retracement level should line up. So in the FXPM software, you always draw from the most current extreme to the old one. So in this example, since we're in an upward trend, from the high to the low. Okay, now after you've done the basic, I'm also going to go in and do more of an advanced one. And now this is where you create a confluent zone. So what we're looking for here is a Fibonacci within Fibonacci, and for these levels to overlap each other. Now what you do for that is, after you've drawn in from the high to the low or the low to the high, you go in and you start looking for critical levels in the market where the price never came back to test, and possibly or preferably ended up running away and starting to trend in that direction again. So when I come to this chart, immediately I see we started having a lot of buying come in right here. We never came back down to test this level. As soon as the market took off there, it's still been continuing to trend higher. So I define that as a critical level in the market. Now what I'm going to draw from is this low that it had made while it was in this range, right down here at the black PMD. I'm going to draw from the high, the most current extreme, to this level now. So I'm drawing Fibonacci within Fibonacci. Now this can be a little confusing at first, being able to go in and find these levels, and it always varies a little bit for each trader. This is what I've learned over the years that's worked really well for me. And actually, when I got into the business, Fibonacci confluent zone, so having Fibonacci within Fibonacci and using candlestick patterns alone, is where I ended up doing very, very well. Before I even came in and started working with Armando, that's something that always kind of clicked with me and allowed me to always have semi-tight stops and do pretty well in the long run. And then I found out those market conditions, not all market conditions are good for Fibonacci retracements. It's only one portion of the market when we're having trends and retracements. When you're in a range and you're not breaking new highs or you're not breaking new lows, the Fibonacci tool, it's not as useful and it's not as accurate as it is when we're in a trending market. So it's only part of, you know, maybe half the time or a third of the time we can use this. Anyways, I've drawn in both of our Fibonacci levels. Now what I look for are these tighter gaps where they kind of overlap each other. So I don't see any just awesome ones. I like to see them, you know, overlap each other within a pip, maybe up to 5 pips. On this one here, I see at the overall 382 and the shorter term 50%, right around 53 to 57. That's what, about a 4-point gap there. And what are we close to here, guys? Anyone catching up? What else we have at this level? We're at big figure. Not only are we at a confluence zone, we're at big figure. And what is this? This is a black PMD, a 5-minute black PMD. So not only do we have the big figure, the black PMD, a confluence zone, and if we also had price action, so if we're down here in the green at this level, I mean, it's a no-brainer right there. You have so many things working in your direction, and that's really what we talk about when we layer the cake. Being able to add in all these different support or retracement levels to really confirm that this level is a price that we would like to take positions and be able to have very tight stops and also have a high probability of the trade working in our direction.